Hi, everybody. It's Martin Wilde from the investment team, joined by Mike Allison. Hi, Mike. Thanks for joining.
Hey, Martin. Good to see you.
And today we're going to go through and give you an update on what we're seeing in investment markets. There's been a lot going on, what we're seeing in the economy, and we're going to focus on where we are year to date through the end of May, and then also talk about some themes that we see going forward that will impact investment markets and potentially portfolios. So with that, we'll start with a recap of what we've seen here most recently in the month of May and leading to the performance that we're seeing across different parts of the market. So on this table, you can see that through the end of May, the S&P 500 was up 11.3%. And so off to a really strong start. And if you recall, the first quarter, we saw a lot of negativity, and we've seen a real resurgence in performance in April and May. So very strong performance from the market. And we see the participation being pretty broad-based, although I will point out that we're seeing real outperformance from the Russell 2000 Small Cap Index, which is up 18.2% year to date, and then also from the Emerging Markets Index, which is up over 25%. And some of the reasons for the strength in those parts of the market, small cap stocks are really benefiting from a lot of economic strength. We'll talk about that. In emerging markets, there are some very large positions in companies that benefit from the AI trade and the technology trade, which has really taken off again, and we'll look at that also. In other asset classes, you can see fixed income has posted positive returns so far this year. So just modestly positive. And then we have seen a lot of volatility in commodities markets. So we've seen with the ongoing war and conflict in Iran, we've seen a surge in energy prices that we'll talk about. And you can see that a broad basket of commodities is still up about 25% for the year. Gold, we've seen some volatility in precious metals, still positive for the year. And then Bitcoin is actually one of the few asset classes we've seen negative performance in year to date, down about 16%. So one of the things we've seen stock-wise within technology, I mentioned there's been this big resurgence in technology stocks, and you can see this on the graph. And if you look through the end of April, you see a number of companies and a number of indices were actually trading in negative territory. But in April and May, we've seen really strong performance, and specifically, so it's impacted the broad markets, but specifically, it has been a lot of the companies that are involved in the hardware side of the AI spending cycle. And that's really resulted in a huge surge in semiconductor stocks specifically. And it's really driven the market higher. And what's interesting, you've all heard of the Mag 7, and historically, the Mag 7 have been leading the market higher. So that's the largest companies and some of the really big, the Apples and NVIDIAs of the world and Microsofts. And the Mag 7 is still positive for the year, but has not experienced the same kind of tremendous run-up that we've seen here recently in the broadening out across other technology stocks. So companies like Micron's really the standout. You can see it there on the graph in light blue, has had a massive surge as people start to really focus on some of the ancillary needs of the technology build out, including memory providers. So we've seen really shockingly strong performance from some parts of the semiconductor and memory chip manufacturers, and that's been also helping lead markets higher. And you can see that the percentage of CapEx that's going to technology has also really surged as a result of what we're seeing in the build out of all the data centers to support the compute power needed for all of the applications that we're using. And I was really surprised to see that we've now gotten technology CapEx spending is over 35% of total S&P 500 CapEx. So you can see that's really a significant percentage by historical standards and has continued to move higher here. And I would say as we look ahead, we're not seeing any signs of that slowing down at this point. So forecasts are that we're going to continue to build out a lot of global data center capacity in the coming years through the end of the decade, and that is going to really drive the economy higher and have a strong contribution effect. And speaking of the broader economy, if we step back, the estimates for where GDP growth is right now, it's running in the 3% range, which is really healthy. And also unemployment has been stable at around 4.3%. So, Mike, you remember that there were when AI started to become more mainstream, and we're still early innings, but some of the initial knee-jerk reaction was we were going to see this big spike in unemployment, and companies would be laying off workers more broadly because AI was going to come in and do everything. We really haven't seen that play out so far. And if anything, we're seeing some interesting signs of economic growth as a result of AI, including the number of new businesses that are being formed is really surging. So anything you'd like to add there or talk about on the employment side and what you're seeing?
Yeah, I think as you mentioned, sort of the knee-jerk reaction when something this significant comes in, people, it's easy to envision, people losing jobs and, all the negative outcome. But what you can't model, or is very difficult to model, is the impact on productivity from that tool that comes in. Speaking of AI specifically, at the moment, I think one of the things that AI is doing, and we're seeing it in this chart here, is that it lowers the bar for folks who are interested in starting their own business. And so I think you're going to continue to see a proliferation of new businesses and entrepreneurial spirit, and that coupled with the productivity gains that we're already seeing in a fairly short period of time. If you think about it, when ChatGPT came on the scene just a few years ago, it's already working its way into the economy and in the way that companies and enterprises are organized. And so I think it's just we're seeing a continuation of economic strength driven by productivity growth, and it's happening a lot faster, I think, than many people appreciated.
Yeah, and all these technology shifts, there's the initial concern that we're going to see all this displacement, but what we've seen in historical technology shifts is that you do see jobs that are disrupted, you do see changes to the economy, but you also see creation of whole new jobs and categories and even industries around the new technology. So we may just be in the early innings of seeing how that plays out too. Another thing to talk about, I know we looked at some of the individual stocks before and some of the amazing performance there. This is just to revisit what we're seeing on the kind of stepping back and saying not everyone is a winner in this trade, because although the semiconductor stocks, and you can see the index there in the green line, has really done incredibly well, up 89% so far this year, and the overall broad-based NASDAQ index is up over 20%, you still see that the technology software-focused stocks within the technology universe are actually still down year to date, and that may surprise people. But as we talk about disruption and change to industries, you have a lot of the technology and the chip stocks doing very well because they're needed to build out all this compute power. But on the flip side, a lot of the tools that have been released have really made it a lot easier to spin up software much more quickly and have reduced the barriers to entry in creating software and competing in that space. And that's why we see the software stocks within the technology sector not do as well.
One other element of that is the software business model is going to be forced, I think, to evolve. Historically, a lot of those enterprise software companies were their model was built around per seat licenses, for example. And I think we're seeing that kind of have to change quickly. And so that's one of the things that the stocks are discounting is a change to their business model, even if their offerings aren't as disrupted in the near term as some people fear. The business model will evolve, and it's probably part of the impact on those stocks.
Yeah, no, that's really well said and a good point. And I think everyone's just trying to figure out when you're valuing these companies, you're thinking about the cash flow streams over the next 10, 20 plus years. And I think there's a lot of uncertainty there now, maybe more so than we saw a year or two ago. So that's all having an impact. On the positive side of AI, though, we are seeing so this is for the S&P 500 more broadly, and we're actually pretty optimistic about the long-term impact that we're going to have on profit margins and the opportunities for companies to become more efficient and make better decisions and reduce waste within the organizations. And we see that the profit margins have really never been higher for S&P 500 companies, and you can see visually it's continued to move higher. And the other thing that's really driving the market higher, there's an old saying that stock prices follow earnings. And Mike, Do you want to comment on just the amazing strength that we've seen in earnings across the market and just how broad-based that has been so far this year?
I think that's, it's an interesting dynamic because, historically the market would be a discounting mechanism for accelerating growth in the economy and earnings. Now it's more contemporaneous, like earnings growth is pulling the market ahead. And we've seen a lot of earnings surprises. We've also seen healthy revenue surprises as well. So the top line across the board is generally pretty strong. And then, as you alluded to, the profit margin expansion has also driven earnings growth. And so the combination of those two things have really driven earnings growth generally across the board, at least most sectors. And as opposed to prior sort of really strong market cycles like the late 90s, for example, this has really been earnings led and not so much multiple expansion. So I think that the market is being pulled ahead by strong earnings growth, and I think that's a more sustainable type of rally than maybe what we would have seen in the late 90s.
Yeah, really strong year-over-year earnings growth. You can see from the most recently completed quarter over, well over 20% earnings growth year over year, even top line revenue growth over 10%, very healthy numbers. And you can see visually all the green on this chart, just so much positive on the earnings surprise in the upper right quadrant, just a lot of positive earnings surprise too. Companies continue to beat their estimates. So a lot of good news, right? Stronger earnings. We've got a lot of CapEx that continues to go into AI. We've got low levels of unemployment. The GDP growth numbers look pretty healthy. So it's like everything seems great. Where do we see some negativity or some of the risks in the market? And I think some of that comes back to inflation. And we do know that we're still in the middle of a very significant conflict in the Middle East. We see that the path for an unwinding of that conflict and hopefully stability going forward, but there's also risk there, right? And one of the things that we have seen while this drags on is a significant move higher in energy prices. And this is a chart that goes back and looks at inflation. So this is going back over a number of years looking at the average year-over-year inflation, or the Consumer Price Index, CPI. Many of you may be familiar with this. And you'll notice that pre-pandemic inflation was running in the, broadly in that 2% range. We saw, of course, a huge spike after the pandemic. We got up to a 9% inflation rate. And then you can see visually that we've been on this long path of inflation coming back down to more reasonable levels and getting close to the Fed's target of 2%. But you can see what's happened here more recently. The last couple of readings have really moved higher. And I think that's something you can see also. The contributing force here is green, which is energy prices. So no surprise, as we've seen oil prices move much higher and gasoline prices much higher, it's starting to have an impact on overall inflation. And I think where that goes from here could impact how we see other parts of the market respond, including what happens with consumer spending and also what happens even with interest rates. And Mike, one of the things I saw here that continues to be a real negative, the May consumer sentiment numbers came out and we saw an all-time record low. This is an index trying to gauge how optimistic consumers are, and it goes back to the 1950s. So do you want to comment on some of the readings that we've been seeing here recently and just how that compares to some of the spending numbers that we're seeing coming out of consumers?
Yeah, I think we've talked over time about in recent quarters about the K-shaped economy, where you have the upper income folks who are benefiting from the wealth effect of higher markets. The folks who are in more moderate income levels bear the bigger brunt of higher gasoline prices, for example, and other inflationary forces. And so I think that's weighed on sentiment. And so I think if you look at sentiment surveys, those are essentially a collection of people, but within that collection of people, there are people who are of higher or lower income levels. And so just by definition, you have more people who are at the lower income level than the upper income level. And so, to the extent that their situation based on inflation is worse than it was a few years ago, I think that's what we're seeing in the sentiment numbers, leaving aside the fact that the higher income folks are doing the bulk of the spending, at least the growth in spending.
Yeah, so a quick takeaway from this is people are saying that in general that they're not feeling great, but because of how spending is distributed, we're actually seeing overall consumer spending is holding up pretty well. And that's been another thing that's been surprising, is just seeing the continued residual strength there, even though the consumers are not indicating in surveys that they feel as optimistic as you might expect given some of the economic numbers. And the last thing we wanted to touch on that's also a spillover effect of what's going on in the Middle East is the prospect for interest rates. Right? And we have been, this chart shows two things. It shows the Fed funds rate. So when you hear about the Fed raising or cutting rates, think of that's tracked in this on the blue line, and you can see it steps up or down depending on what the Fed has been doing recently. And you see visually that we've been on this path of rates coming down, pause, coming down, and then paused again. And there's a question that markets have on what is the Fed's next move. Now, one of our colleagues likes to point out that the 2-year Treasury, which you see here in green, can actually be a good predictor of future Fed activity. And if you look to the right side of the graph, you'll see that's been moving higher recently. And we also see that in the Fed funds futures. So when markets are predicting what the Fed's next move is going to be, I think more participants now are starting to think the Fed may be on pause for an extended period of time, and actually their next move might be more likely to be an interest rate hike than a cut. Now that's all, all depends on where the data comes in from here. But Mike, anything you wanted to add on what we're seeing on the rate side of things?
Yeah, I think that's that's what the markets are saying, is that we certainly the prospect of interest rate cuts is I think very low, if non-existent. Maybe the Fed's on hold, and there's a good chance that the next move is rates go higher. And to the extent that as we were talking about inflation creeping up, even if things get settled in the Middle East right away, there's still going to be some knock-on effects that's going to take a while for inflation to work its way down. And so I think the Fed is going to really have to be mindful of that. And I think there's a good chance that their next move is higher, which also presents some fiscal challenges because higher interest rates means higher interest expense by the federal government, for example. So that's problematic as well. So there's a lot of countervailing forces, but my own sense is that the next thing the Fed does is actually raise short-term interest rates.
Yeah, so certainly a pretty different view than we had a number of months ago on what the Fed was most likely to do here going forward, and we'll keep watching that. So just wrapping up, we publish the dashboard every month, and this is really, these dials are designed to just give a quick read for investors on where we see strength and areas of weakness and risk in different parts of the market. So Mike, do you want to take us through this and take us home?
Sure. I think, from on the economy, we're seeing solid growth. As we said, there may be some stress on the households, particularly of more moderate income levels. The dial remains sort of 5 out of 10 right there in the middle. We did lower, based on this conversation we're having about monetary policy and the risk that the Fed raises rates. We moved monetary policy from a neutral to a negative, and the financial conditions dial is at a 4. But the market's been very strong. Valuations are reasonable, particularly in certain areas of the market. Earnings have been strong, and the market upward trend remains intact, and so we're at a 6 out of 10 on the market conditions. But we're mindful of the impact of the very dials on the other dials, and so to the extent that the economy weakens or financial conditions get even worse, then maybe we have a different view on the market. But for now, we're constructive on earnings and in the trend of the market, and so we're at a 6 out of 10 there.
That's great. So overall, we continue to watch things closely. I think the biggest risk factors really stem from inflation, if that gets out of control, and potentially the spillover effect on interest rates. Right now, other economic indicators look pretty healthy, and of course, the companies are doing great, and corporate earnings broadly have been incredibly strong, and helped by the incredibly resilient CapEx spending cycle that we've seen in the continued build out of data centers, and then also the consumer holding up, I think, much better than people might anticipate, even with some of these pressures. So overall, we don't see any immediate risks. We'll continue to keep an eye on the data and report back. And thanks so much for spending time with us. Hopefully you found this of help, and don't hesitate to reach out with any questions.
Thanks, everyone.